We're back. Time for Ask Annex. Matt Morzy's in the studio. How does the Annex investment team evaluate risks and rewards associated with investing in emerging markets?
Any part of a balanced global portfolio, you are going to want emerging market exposure in there. Yes, there's heightened risk. The volatility there is going to be a lot higher than in potentially in other parts of the world, but with higher risk, also the potential for higher rewards. And you have created a level of diversification by having that in there as well too, so that if there's a time period where the U.S. is not performing, there's a high likelihood that emerging markets might be. You know, you think back to the 2000s when the S&P was essentially flat over that decade, emerging markets was actually up quite a bit, and that was really the best performing stock asset class then. In terms of how to invest in that area, we largely like to use actively managed funds within that area. We like to use portfolio managers who have boots on the ground, that visit those countries, that have a really, really in-depth knowledge of what country are they investing in, what's the political risk there. Is it something like China that has state-owned enterprises as a portion of what they do, or is there more economic freedoms that would closer align to who we are? And so they balance those risks along with the companies themselves. They look at the data that's coming in and how reliable is it from each one of those countries, and they try to essentially outperform their benchmarks by doing that. So we really want to rely on that expertise in the vast majority of situations to do that. We do have some indexing in that area as well too, to gain broad diversification at a lower cost, or some hybrid strategies like that. But ultimately, you really want somebody who knows that area.